Welcome everyone. In this recording we're going to go over Chapter 1, An Introduction to Accounting and Business. So our slides here outline some of our objectives. I'm actually going to skip over these and then at the end I'm going to circle back to them, is how I like to think about them. And we'll walk through them and answer them and make sure after our lecture that we actually are achieving our objectives. Throughout the course, if I appear to just skim over a slide or not really emphasize a definition or a concept, you can go ahead and also not put a lot of emphasis on it. Some of the things that are a little bit more basic, or I think you would be able to easily interpret or understand from reading yourself in your textbook or on the slide, I won't emphasize. So if you notice me doing that, you can interpret it in that way. So we have the definition of a business and profit. Profit, simply your revenues minus your expenses, that's your net income. We talked about that in our first video. That becomes our value on our income statement. There are many types of businesses, and when we walk through journal entries in this course and recording activities and different types of items, we come at it from a perspective that, we're not going to just pretend all semester that we're a manufacturing business. We will talk about how you can record journal entries for service type businesses, merchandising, different things. So here the slides have outlined for us just this concept that there are like multiple types of businesses, different lines of things, and when we practice accounting and these journal entries, we will practice it from a variety of perspectives or acting like we're a certain type of business. Here our slide is defining accounting for us. They're defining it as an information system that provides reports to users about economic activities and the condition of a business. In our first video, I also provided you with a definition of accounting that I like to walk through conceptually some of our main points. This is also a great definition. And here they're outlining that accounting identifies users, their needs, designs a system to meet those needs, records data, and prepares reports. And this is very similar to what we've already talked about. We talked a little bit about financial statement users. Who is a user to the financial statements? Say we are a publicly traded corporation. This is probably either an investor or a financer. So if we know our users, we can better interpret what they might need and design our accounting information to meet that. I think we discussed this also a little bit in the first video, but accounting systems are the heart and soul of, an accounting department in any company, and there's many modifications you can make to them to achieve your business objectives. So if there's certain things you think you need to be able to report or provide information or data on, you can design your accounting system to go ahead and do that. And then lastly, after we do steps 2, 3, and 4, we get to actually preparing the reports for our users. So after knowing who they are, what they need, modifying anything for them, we can go ahead and prepare them or provide them with our final product. And here's a little fun infographic. Something else I'll point out is I don't really want you to memorize anything we talk about. The slides will go through a variety of concepts. What's important to me is that you listen and you think for yourself and you try to put the pieces together and come up with your own examples and things like that, and you ask me questions. I don't want you to be able to regurgitate these things by the end of the course. Obviously, it would be great if you could come up with your own working definition of accounting, but I'm not going to quiz you on any of these little infographics without also giving you the resource of your lecture or your textbook. So please don't feel as we go through lecture that you need to be memorizing things. I just want you to pay attention and listen and ask questions and get a better sense of accounting as terminology and as a potential career. So this class is financial accounting, and our main objective is understanding the process and end result of a financial statement, but there is also something called managerial accounting. Financial accounting focuses, again, on the financial statements, and financial statements are for external users. They're for people outside of the organization, whereas managerial accounting, also called management accounting, is for internal users. Just like there are public accountant auditors who audit companies, each company also has their own accounting department, right? And those are people in management accounting who are internal people preparing information only for internal use or decision making. I think even if you're not an accounting major, right, you're taking managerial accounting at some point in your degree. So that will be kind of the next step in your accounting building blocks, the next course. And this is often called going into like private accounting or industry accounting. So financial accounting, again, is preparing things for the outside user, someone outside the organization, to help them make decisions. And is the preparation of financial statements for distribution to those types of external users. So we create financial statements for a variety of reasons, right? Because we want our users to be able to get the information they need. But that information is not helpful if it's not relevant and timely. If we're giving them information that is excessive or we're underreporting and we're telling them how 2019 went 3 years later, that's not helpful to them. So that's our objective here. We're preparing those financial statements for our external users, but they also need to be designed with their needs in mind, and they also need to be prepared, within a certain time frame so they're, relevant and able to make decisions. Accountants in general have a high requirement for ethical behavior. No one wants a financial statement that was prepared by an accountant or a firm that is not ethical and making good decisions and has good judgment and is trustworthy. So that's an important pillar of accounting. And then the people within the organization that are recording those everyday journal entries and transactions, they also need to be ethical and behaving in a manner that is indicative of a successful and ethical organization. Within the past, I would say 15 years, there have been some really shocking examples of accounting and business fraud. There are a few that are widely talked about because of A, their dollar value, B, the method in which they committed the fraud, or C, just how shocking in general it is. A big one that is often referenced both in textbooks and in the quote-unquote real world is Enron. So they were fraudulently inflating their financial results and ultimately had more than $60 billion in stock market losses. And there's a lot of really interesting documentaries about Enron. Actually, the one I watched, it was a few years ago, was on Netflix. It's just very interesting how they did everything. And ultimately the way they were, kind of found out or gotcha'd is there was a journalist or reporter, and she kept asking Enron, well, how do you make cash? How do you make money? And no one could really answer that question very directly. And so something I've seen with all these different frauds is people just say, follow the money, follow the cash. If it seems like it's too good to be true, or how could they possibly be generating these types of revenues, a lot of times it is. So if this is something you're interested in, Enron is a very frequently cited example. There's a lot of cool documentaries, kind of follow their tragic, but, their own fault, their demise. And this is why there's kind of this emphasis for ethics lately in accounting. I think it's always been there, but we've seen recently how destructive it can be to the stock market when these big companies fail for reasons that have to do with ethics and proper accounting behavior. So now, if you're a CPA, a certified public accountant, you have a series of required ethical trainings that you must complete so you can understand what's expected of you and what is ethical behavior. So something that a lot of times when we think about these different frauds or business failures is what went wrong. And our slides here have kind of summarized either it's a failure of the individual's character or a culture of greed and ethical indifference. So for you right now, another good thing as students to think about, or, you know, a lot of us have multiple things going on in our lives, maybe we already have full-time jobs, whatever, is kind of setting your own, you know, ethical guidelines. What's the line for me? And thinking about hypothetical situations, because sometimes you just don't know until you're in them, how you'll feel, how you'll be influenced, and kind of, you know, what lines will you not want to cross. And it's good to kind of develop that framework for yourself. I think it's something I do. Being a CPA, working at a public accounting firm, and being involved with great organizations, I have this personal line of what do I expect from myself? How do I behave? How do I perform? And I never cross that, no matter the circumstances. As a result of all of those accounting frauds in the last two slides, something called SOX was passed, the Sarbanes-Oxley Act. I think it was 2 congressmen. And this was a law that was implemented to try to prevent these types of accounting and business frauds. And SOX is overseen by something called the PCAOB, the Public Company Accounting Oversight Board. There is a ton of acronyms in accounting. And this SOX, it was passed in the early 2000s, shortly after the Enron debacle, established a lot of standards for independence, reporting, responsibility, disclosures, ethics. So it was kind of a legislative attempt to prevent these kind of things from happening again. And here they've outlined guidelines for behaving ethically. I know everyone here probably won't think to this slide when you're posed with a difficult situation in your personal life or in your professional life, but you know, I don't expect you to follow steps 1 through 4, but it is something to think about, kind of developing your own framework and saying, you know, what are the lines I won't cross? How do I want to behave? How do I want to be perceived? And, you know, I want to be perceived as trustworthy and ethical, and what can I do every single day to make sure that's who I am as a person and as a professional. So, of course, you know, we have to have a plug here for accountants. There are so many different career opportunities in accounting. I will say it has been a great opportunity for me. There's things you wouldn't even think of. Every organization needs an accountant. So there's the potential to work in really cool companies and be involved with organizations that do really great things for communities and the economy. So if you're thinking about accounting as a major, or you already are an accounting major, I think the job market has the potential to be quite lucrative and then also flexible. There's a lot of different realms you can go into. Our slides here mention this is partly due to all of the regulations, and so that is true. So when they passed SOX, a lot of publicly traded companies had even more reporting requirements, even more disclosures, and as a result, they needed their accountants even more, both their internal accountants that prepare, management accounting information, then also external people that prepare financial information. So due to this regulation, there became a lot of employment opportunity, and then a lot of businesses have just, come to accept the inevitable. Accounting information is important. You can do good work day in, day out. You can make money day in and day out. But if you can't show it to people in a usable format, then a lot of your triumphs might not be really recognized. So again, going back to this concept, accountants employed by a business are in public accounting, or private accounting, private accounting, where they're making management or managerial decisions, and then accountants and staff who provide services to companies for fees, whether they're completing an audit, tax work, consulting work, are said to be public accountants. And public accountants need to have a CPA licensure, a certified public accountant licensure. And this is based on state-by-state guidelines, so certain education requirements, and then you have to take a 4-part examination. In Ohio, if you're thinking about pursuing your CPA, you need to have earned 150 credit hours, which is more than a typical bachelor's degree, and you have to have met certain minimums of hours in different accounting coursework. And then you have to work in public accounting for a year, and you need to pass a 4-part exam. It's quite comprehensive and challenging. So if that's something you're thinking about pursuing, those are some really, really basic guidelines. I'd be happy to talk to anyone about it more. I think it was a worthwhile pursuit. Here they're kind of outlining some general starting salaries, and one of the things I like to talk about in this course is don't let this slide limit you if you're thinking about being an accountant and pursuing that as a career path. Yes, you could go into any of the items listed here, but there are many, many more interesting things you can also get into. And I encourage you also to, research what are my opportunities, what kind of compensation am I looking at, what kind of certifications or experience might I need to get there is always a good idea. Here's some kind of general salary guidelines for public accounting. And again, even in public accounting, I don't think you need to limit your scope of what's possible. Public firms have lots of different services they offer. They have very interesting services in consulting, dealing with business acquisitions and disposals, and helping to design accounting systems and things like that. So don't limit yourself if you're thinking about being in accounting and pursuing that as a career path. There's lots of different options. So our financial information that we'll talk about in this course is based on something called GAAP, G-A-A-P, Generally Accepted Accounting Principles. So this is our standard for how financial statements are created. These are the rules that determine how we record business transactions and principles and assumptions on how we would present our financial statements. So these GAAP principles, generally accepted accounting principles, are governed by the FASB, the Financial Accounting Standards Board. And then we also have the SEC, which I think is a little bit more commonly discussed as a phrase, as they're overseeing every publicly traded stock. And then outside of the US, there's the IASB, which is the International Accounting Standards Board. So the rules for accounting in England are different than the US, and that's something, if you take the CPA exam, is covered extensively. I always think about it as kind of like Microsoft and Apple, like in terms of the processing system. Like everything is just a little bit exactly opposite, but it is interesting to study if you are pursuing accounting and you get to that point in your studies. So again, I don't want you to be memorizing everything, but let's talk about what financial reports need to have to be helpful. They need to be relevant, and they need to be faithfully represented. What does relevance mean? Well, we talked about who is the user of our financial statements, what do they need, and that's how we create relevant financial statements. And then we need to represent things faithfully or truly. So the information that we show in our financial statements needs to be accurate. It needs to accurately reflect what went on and the condition of our organization. And then those two concepts of relevance and faithfulness are further enhanced by these items here. So financial statements need to be comparable. And in our first video, we talked about this a little bit. We need to be able to look at a report from 2019 and a report from 2018, and it needs to be identical. How can we tell the growth year over year if one year they presented the currency in euros and in the next year they present it in US dollars? How can we compare if one year they show all of our fixed asset accounts, our buildings, our vehicles together, and then the next year they break them out. So things need to be comparable year over year so that the users can see the changes and notice similarities. And then also things within the report need to be verifiable, and this just means that definitions are identical among different financial statements. So if we say this is cash, well, cash needs to mean the same thing from Target as it does to Walmart's financial statements, as it does to Apple's financial statements, as it does to Microsoft's financial statements. Everything needs to have identical meanings so we can understand among different entities. And then also timeliness. So if a company ends their year on December 31st, if we don't see the financial report for that year until the next December 31st, that's hard for us to make a decision, right? We weren't provided with information in a timely manner. Now, financial statements aren't available the day after the end of the year. There's a turnover period, things need to be reviewed, potentially audited, whatever the situation may be. So you're looking a few months out, but you're not looking years and years out. Things need to be timely. And then financial statements should always be understandable. They should not be overly confusing or wordy or require a lot of additional analysis on your part. So we said financial statements need to be relevant and faithfully represented. And then we also need them to be comparable, verifiable, timely, and understandable. Now there are an additional 5 assumptions that when we go and look at any financial statement that has been audited and is available externally, that we should be able to assume. The monetary unit, the time period, the business entity, and the going concern assumptions, and we will talk about those. So monetary unit simply means that we're looking at things in one single currency. So either a US dollar, a euro, a pound. We're not looking at things upon a different type of financial currency because that's really hard for us to know, right? If they show their revenues in dollars and their expenses in euros, how could we possibly understand the financial statements? So it's an assumption when they're prepared that they will be prepared under one single currency. And then there's also the time period assumption. So financial statements are prepared for, traditionally a year, and if it's not a year, it will say. That way we know they're periodically prepared, they're consistent. Most companies prepare and report their financial statements with a traditional fiscal year, so start on January 1st and on December 31st, but they can choose to do other types of dates or timelines. And then there's the business entity assumption. So this is saying the business is separate from the people involved in it. It's separate from its owners, it's separate from its creditors, it's separate from any other businesses it interacts with or is related to unless disclosed. So when we look at a financial statement, we're looking truly at the business. We're not looking at the people running it or managing it. We're looking at the performance of the business itself. And there are 4 different forms of business entities that we'll talk about just really in this chapter. In a lot of our examples throughout the course, it will tell you what type of business structure it is, but just 4 to outline. So the first is the proprietorship. So this is a business owned by an individual. The matrix here kind of breaks out some advantages and characteristics, but I'll just provide a few of my own as well. So proprietorships are very easy to set up. They're not expensive to create. It's not a lot of paperwork. But the downfall is that the proprietorship has almost unlimited liability to you as the proprietor. So if the business goes under and you owe lots of debts, those can come back on you personally. Next is a partnership structure. The partnership has a benefit in that it's a little bit less of a financial burden, right? Because you're sharing all of the expenses among multiple people, 2 or more. But then you're also splitting the profits and you're also splitting the decision making. And I think that could be a challenge because getting everyone to agree upon one course of action could be complicated, could be take a lot of time, and otherwise slow down your business decision making. There's also a corporation. A lot of people are probably very familiar with corporations, and corporations are interesting. So if we talk about FAANG, that's FAANG, those are our big 5 in the stock market, and they're all corporations: Facebook, Amazon, Apple, Netflix, and then Google, which also trades under Alphabet, as you can see in our examples box there. Those, corporations have a huge benefit in that they're a completely separate legal entity. So if Bezos at Amazon has issues, the business is separate from him as an individual. Now, I'm not saying, a lot of his net worth is, almost all of his net worth is completely because of Amazon, but it's a legal entity, and therefore when people are suing Amazon, they're not suing him directly or in any other legal situations. So it's almost like, okay, well, why doesn't everyone just be a corporation? That sounds great. Well, the problem is it's time consuming to set up, it's expensive, you're subject to a lot of regulations, so that's something that prevents a lot of people from deciding on the corporation structure. And that's typically why you see like the big names in the economy are corporations. And then lastly, we have the LLC structure. So a lot of my friends and family that own their own businesses, I see them do this structure. It's beneficial because it's exactly what it says. It's limited liability. If there's issues with your business financially, they don't come back on you directly as the owner. And then it's also easy to file for an LLC. It's not a convoluted process. It's pretty available. The only downfall is sometimes there's complicated rules on paying out wages to yourself. You obviously can pay yourself a salary, but it's a little bit more complicated than it is with other business structures. So the last assumption, we said there are 5 assumptions when we go into the financial statements, is the going concern assumption. So when you look at a financial statement, unless it says otherwise, you can assume that the company has no indications of going out of business in the next, for the foreseeable future. So when you pick up a financial statement, that's something you can read it with that understanding. Unless they specifically say, hey, we're having some tremendous issues, we have some tremendous debt coming due, you can read a financial statement with the understanding that the business will continue in perpetuity. So we have the monetary unit, the time period, the business entity, and the going concern. Those are all assumptions when we look at a financial statement. And then we have 4 principles of financial statements. The first is measurement. So everything in our financial statement should be objective and it should be verifiable. Objective means could be independently confirmed. What do we mean by that? Let's use an example of cash. Cash in an audited financial statement is probably held by an institution, right? Let's say they have a checking account at Wells Fargo. We can go to Wells Fargo and we can say, hey, Wells Fargo, did this company actually have $350,000 in cash on December 31st? And Wells Fargo can say, yes, they did. And now it's objective. It's based on independent evidence, independent in terms of the third party, Wells Fargo. And we've also verified it with them. So that's something a measurement principle is an example of. We can confirm cash. You can also confirm debt. Why might you want to confirm debt? Say a company says, oh, we owe $900,000 on a series of vehicle leases. Why do we care about confirming that? What if they've underreported it? What if they actually owe $1 million? If we reach out to their bank or their lender and we say, hey, do they owe you $900,000, but they really owe $1 million? You can guarantee that lender is going to come back to them and to the people auditing them and say, no, that number is not correct. They owe $1 million. So cash liabilities are objective and verifiable. Another principle is that transactions are performed at arm's length, meaning it's between two independent parties, trading, providing goods, purchasing goods at fair market values. So if this is not the case, if a financial statement has a related party that is selling them lumber at 2/3 of the actual cost or market value, that needs to be disclosed, because otherwise it's not fair to the users to look at their expenses and say, oh, wow, their expenses went down a lot. Well, they went down because they're doing business with a related party that's not charging them fair market value for goods. So all transactions need to be arm's length, and if they're not, that needs to be disclosed. And then another thing that is a principle of our financial statements is historical cost principle or cost principle. This means when we purchase something and we record it at cost. So when we purchase a building, we record it at cost. When we purchase a vehicle, we record it at cost. Next year, if our vehicle depreciates, we don't just change the value of the vehicle. We don't say, oh, well, year has gone by. Second, we drove it off the lot. It had less value. Let's go ahead and say it's only worth $18,000 instead of $30,000. Can't do that. You need to record items at historical cost, and they need to remain that way. Now, vehicles do depreciate, and we'll talk about that and record that in later chapters, but we don't get to go back and actually revise the amount of the vehicle. The vehicle, a building, an asset, stays on our books at cost, what we purchased it for. And then we also have the revenue recognition principle. And this is talking about when do we record revenue. So, say we have a sale to a customer, and we will go to their house on Friday and clean their windows, and they're going to pay us $500. And we set up this time frame with them on Monday. We don't get to record the revenue on Monday, right? Because we haven't delivered the good or service to our customer. So there's this revenue recognition principle. And when you're looking at financial statements, you should be able to look at them and say, if they're recording revenue on their financial statements, it means they've truly performed the service or delivered the good to their customer. Same thing with expense recognition principle. This is sometimes called matching. What does this mean? It means we need to record expenses in the period in which they occurred. So if we have an expense around the end of the year, say around the holidays, we buy some gift cards for our employees to give them a little bonus, maybe some Giant Eagle gift cards to perk them up for the holidays, thank them for their work for the year. But say we bought them on our credit card, and our credit card bill doesn't come until January. We still need to make sure we're recording the cost, the expense of those gift cards in the year they occurred. Otherwise, how can we compare profit and loss, right? If we wait until the next year to record the expense, that's not an accurate representation because the expense was associated with the previous year. It needs to be recorded in that year. We talked a little bit about the accounting equation in our first video together. So assets are resources owned by a business. Liabilities are the rights of creditors or the debts we have. And then the rights of owners is called equity. And you'll probably see this. There's stockholders' equity and owner's equity. What's the difference? Stockholders' equity is the equity of a corporation, someone that has publicly traded stock, most likely. And then owner's equity is all the other business structures, proprietorships, partnerships, LLCs. Here's our accounting equation presented again. Assets equals liabilities plus stockholders' equity. This is an interesting point they show here, and it's very relevant. So liabilities are shown first in the equation because if your business goes under or your corporation, whatever goes under, your creditors get to try to claim their losses from your assets before your stockholders. That's why investing can be considered risky, right? Because if for some godforsaken reason Amazon was to fail, the people who've invested in Amazon and hold stock in Amazon, they might just lose their stock value, right? Because Amazon owes a lot of money to people, probably in the form of creating warehouses and infrastructure and machinery. And the people they owe that money to would get to claim those debts from the business before the stockholders get paid off. So that's why liabilities are shown first. That's why it can be considered risky to have investments, because creditors, not stockholders, have first rights to assets. So business transactions are anything that impacts the financial condition or operations of a business. We use this example of purchasing a building with cash in our first video, and here they're saying a simple business transaction would be a company purchasing land. So these slides are going to outline the impact of these transactions on the accounting equation, and we will walk through that. But then what I also want to do is go ahead and show you what these transactions would look like in the form of a journal entry. So we're going to go ahead and walk through that together. Okay, so the first transaction we're going to walk through is transaction A. It says, on November 1st, Chris Clark deposited $25,000 in a bank account in the name of Net Solutions in exchange for shares of common stock in the corporation. When we walk through a transaction, we want to pick out our accounts. So the first account that we're identifying here is assets of cash. When they deposited the money, they got the cash in their bank account, and there has to be another side to the transaction, right? So we can see that they received equity in the form of common stock, and common stock is defined down here. This is what a corporation issues to investors as proof of their ownership rights. So essentially this transaction is someone investing in the company. The company is getting $25,000 of cash, which is an asset, and the other side of the entry is equity in the form of common stock. Cash holds a normal debit balance, and equity holds a normal credit balance. So this equation balances because we have $25,000 of cash, $25,000 of equity. Cash is a debit balance, a positive balance. Common stock is a negative balance, a credit balance. Plus 25,000 minus 25,000 equals 0. So now that we've walked through it in this form, I want to walk through it in the form of a journal entry, because I think the slides initially go through focusing on what accounts we're hitting, and we'll walk through that in each transaction. But I think if we can also summarize it in the form of a journal entry, which is what you'll really be doing in this class, I think that's helpful, so we can just kind of get to those building blocks a little earlier. Alright, so this is the same exact transaction you just saw on your slide. So now I just want to prepare it in the form of a journal entry. And I pulled these concept reminders from our spreadsheet accounting course and content introduction that is available. So again, on November 1st, Chris Clark deposited $25,000 in a bank account in the name of Net Solutions in exchange for shares of common stock in the corporation. The first thing we need to do, remember every journal entry has a date, so I'm just going to pretend this is 2003. So I date my journal entry. Every journal entry has a debit and a credit, right? So I need to figure out what those are. The thing I think is most helpful as a first step is to identify your accounts. So as we noted as we walked through the example, the accounts are cash and common stock, which is a type of equity. I know that I'm debiting cash because if I look up at my reminder of what is a debit is recorded when there is increase to an asset or a decrease to a liability. We increased our cash because we received cash, right? And we're actually increasing our equity because someone is investing in our company. So we know our debit is cash, and the debit is always just the amount of the transaction, $25,000. And we know our credit is to common stock. That's a type of equity. And again, our amount is just the form of the transaction. And then we always include a brief description of the business activity. So, invested in Net Solutions. Why did I credit common stock? Credits are recorded when there is an increase to a liability or an equity account. We increased the equity account of common stock, and that is why I credit it. If we go back to our slides, that's transaction A. Let's walk into transaction B. So on November 5th, Net Solutions, and this is the company we're recording things from the perspective of, paid $20,000 for the purchase of land as a future building site. The first thing we want to do is identify our accounts. In this transaction, what accounts are being impacted? Well, we paid $20,000. That means we paid in cash. So we're identifying cash as an account. And then we paid the cash to get land. So we know we are receiving land in exchange for cash. Cash is an asset. It's a resource our business uses to generate activity. Land is an asset. We're using it as a future building site that will help our business. It's an asset. So here we have a transaction where it's both impacting an asset account, cash, we're paying to receive land. So let's go ahead and record that in the form of a journal entry. So now we're down here, transaction B. On November 5th, so we want to date it, Net Solutions paid $20,000 for the purchase of land as a future building site. I need a debit and I need a credit. We know they're both asset accounts. Land assets have a normal debit balance. So if I'm receiving land, that's my debit. And if I'm paying cash, I need to credit cash. Why do I do that? Well, cash has a normal debit balance. And so if I'm reducing cash, I need to credit cash. And we can see up here the reminder of that. Credits are recorded in journal entries when the transaction is decreasing an asset. So that's what we're doing in transaction B. So I've identified my two accounts, land and cash. I've recorded the amounts based on the purchase price of the transaction. And then I always want to record my little description here. Purchase of land as future building site. All right, on to transaction C. On November 10th, Net Solutions purchased supplies for $1,350 and agreed to pay the supplier in the near future. We need to identify the accounts that are impacted by this transaction. We are receiving supplies, right? Supplies are an asset. They're something that our business can use to generate income or revenue. And then we are not paying cash here, right? Like we did in the last transaction. We have an agreement with our supplier that will pay them in the near future. That type of account is called an account payable. So we keep a running balance with them. It's a liability to us because it's cash we owe them but haven't yet paid. So that's the impact here. And then remember, in accounting we have the concept of the matching principle that we talked about already in this chapter. So we don't get to record the supplies because we haven't used them yet. What we need to record the supplies as are prepaid expenses. What's a prepaid expense? It's just something that we pay for today that we'll be using in the future. We can't record it as supplies because it's prepaid. So I'll show you the journal entry for this type. So we record our date. We need a debit and we need a credit. What are we receiving in this transaction? We're receiving a prepaid expense, supplies. And how are we paying for it? We're paying for it with a liability, a promise to pay in the future, in the form of an account payable. So I debit my prepaid expenses for the amount of the transaction, and I credit my account payable, my liability. Why do I debit and credit these things? We just revisit our entry, right? If we're debiting something, we're increasing an asset or an expense account. Prepaid expenses are an asset because they're a resource we can use in the future. They are not yet an expense to us, right? Because we haven't used them yet. So we're going to show them as an asset in the form of prepaid expenses. And then why are we crediting accounts payable? If we revisit our definition, when we credit something, we are increasing a liability or an equity account or decreasing an asset or expense account. We know accounts payable is a liability because it's a debt owed to someone in the future. So that's why we credit accounts payable. Then we have transaction D, and transaction D gets into the concepts of revenue. So when a business earns money by selling their goods or services, this is our simple working definition of revenue. On November 18th, Net Solutions received cash of $7,500 for providing services to customers. Let's record that transaction. We need to identify our accounts. We have cash coming in, and we provided services. The providing of services is a type of revenue. Revenues and expenses fall under our equity category. So we're going to have a debit to an asset in the form of cash, and we'll have a credit to equity in the form of fees earned, a type of revenue. Just like always, we go ahead and date. Oh, I forgot my business description here. So transaction D, we go ahead and date it, and we need our debit and our credit. We know our debit can either be an increase to an asset or expense account or a decrease to a liability or equity account. If we look at our activity here, we are increasing an asset in the form of cash, so that's our debit, form of $7,500. And then what's our credit? A credit can either be an increase in a liability or equity account. That's not our situation, right? Because we're earning revenue in the form of services we provided. Or it's a decrease to an asset or expense account. Oh, wait, sorry, I said that wrong. An increase in a liability or equity account. This is our situation here because our services earned fall under the umbrella of equity because it's a type of revenue. So that's why we are going to credit services for $7,500. And then our business description can just be provided services to customers. I'll go back over this one more time because I realize I misspoke there. So again, we're debiting cash because it's an increase to an asset. Our customer paid us for services. And then we credit our services. It's a type of revenue because crediting a service is an increase to equity. Equity is made up of either revenue or expense. So that's why we credit our services earned. All right. And remember we talked about the fact that throughout this course we'll have multiple different types of business perspectives. We'll look at service organizations, merchandising, manufacturing. So when we look at all those different types of businesses and the types of transactions they would record, they also earn revenue in different ways. So if we're providing services, we're earning fee revenue. If we're a merchandising company, we're earning sales revenue. If we are a real estate company or an investment company, we're earning rent or interest revenue. And the slides also point out an account receivable is a claim against a customer, which is an asset. And we'll talk more about that. A lot of times, and this is pretty common in business, instead of receiving cash at the time the services are provided, a business can choose to accept payment at a later date. This is just like the accounts payable we just talked about. When you think about it, this is a pretty common transaction, right? Say you get goods delivered to your warehouse. Your warehouse workers aren't standing there with cash ready to pay the delivery people. So someone who has a long-term relationship, a business that has a long-term relationship with another business will often extend credit in the form of accounts payable, and to the person receiving that, to the person holding that liability, that's an account payable, and then to the company that expects to receive those funds, that's an accounts receivable. Now we have transaction E. During the month, Net Solutions spent cash or used up other assets to earn revenues. So this is common, right? When we talk about assets, we say those are things the business owns or uses to generate business or revenue. Assets are used in the process of earning revenue, and those are called expenses. We know revenues and expenses fall under the umbrella of our equity activity. We have assets, liabilities, and equity, and under equity, there's revenue and expense types. So on November 3rd, Net Solutions paid the following expenses: wages, rent, utilities, and miscellaneous expenses. So the first thing we want to do is identify the accounts impacted by the transactions. So we're paying wages, we're paying rent, we're paying utilities, and we're paying miscellaneous. Those are types of expenses, and we're paying them with an asset of cash. Let's go ahead and record. So just like always, I want my date. Okay, so here for the first time, we're going to have a journal entry that has more than one debit and credit. And remember, this is perfectly acceptable, very common. Each journal entry has to have at least one debit and credit, but they can have more. And this is the first time we'll see that. So we paid wages, so I debited all of these things. So the wages were 2,125, rent was 800, utilities were 450, miscellaneous was 275. Why did I debit them? If we go back up to our working definition, we debit something if it's increasing an asset or an expense account. Remember, our expenses are increased because we paid all of these different types of expenses: wage, rent, utilities, and we paid them with cash. I credit cash because I'm decreasing an asset. And remember, my debits have to equal my credits. So I paid a total of $3,650 of expense using an asset of cash. And I'll add my business description or transaction, paid monthly expenses. Now we have transaction F. On November 30th, Net Solutions paid creditors on account $950. Remember, we just talked about an account payable. So an organization had extended us the option to pay at a later date. That created a liability for us in the form of an account payable, and it created an asset for them in the form of accounts receivable. So now that this time has passed, we are going to pay them for an invoice that is goods we received much earlier in early November. Now we're going to go ahead and pay them. And in doing so, we are going to reduce an asset in the form of cash. And we're also going to reduce a liability. And that's a good thing, right? Because we don't want to have a lot of liabilities. So we have to use an asset to pay it. So we'll talk about that. All right. So we said we are reducing a liability. So if I come up here, one of the options in my definition of a debit is we debit something if we're decreasing a liability. Accounts payable is a liability. It's a promise we made to a vendor or supplier to pay them in the future. So if I'm paying them for that business activity, I go ahead and I debit my liability. Then I pay for the liability in the form of cash. I'm decreasing an asset of cash, so I need to credit that. And then I record my business description, paid creditors account. Now I have transaction G. On November 30th, Chris Clark, he must be a management person in Net Solutions or some other type of employee, determined that the cost of supplies on hand at the end of the month was $550. If you remember back to transaction C, we purchased supplies of $1,350. So now Chris Clark, our employee or manager, is going and he's counting the supplies and he's saying, okay, we have $550 worth of supplies left, so that means we must have used $800 worth. The $1,350 we started with minus what's left equals what we used. So to record this transaction, we need to think about our accounts. So we recorded that prepaid expense account, right? That was an asset to us at the time. And now we actually have a true expense, right? We actually used these supplies. So we need to record an supply expense, and we need to reduce our prepaid expense that we recorded back here, right? We recorded a prepaid expense as a debit, so we need to reduce that. Let's go ahead and record it, and we'll talk about it a little bit more. So I'm recording supplies expense because when we bought the supplies, we hadn't yet used them. So it was not accurate to record it as an expense at the time of purchase. Now we've used them. Chris Clark went and he counted and he said we had $1,350 worth of supplies. I think we have $550 left. That means we must have used $800. So we're going to go ahead and create a journal entry to show that we have an expense associated with the supplies. Now, what's our credit? Well, if we come back up here, we know credits can be an increase of a liability or equity account. That's not our situation here. Or they can be a decrease of an asset or an expense account. Remember when we initially recorded the purchase of supplies here, in transaction C, we called it a prepaid expense. That's an asset. We haven't yet used it. Now we've used it. So we had this much, and we need to credit it now. It was an asset, we're using it up, so now we credit the asset. And this makes sense, right? Because if we took our initial prepaid expense, debit balance of $1,350, and we credit the prepaid expense account $800, now we have $550 left. And that's how much we have left in supplies, so that makes sense. So, forgot my date here. Record a business transaction, description, use of supplies during the month. Now we have transaction H. So on November 30th, Net Solutions paid dividends of $2,000. Dividends are defined as a distribution of earnings to stockholders. You won't see dividend activity in every type of organization, only those that sell shares of stock to investors called stockholders. So you need to think about our account types. So we pay dividends out in cash, so we know we're decreasing an asset in the form of cash. And then paying our dividends is a type of expense, and that falls under our equity category. So we can go ahead and record this. So we have dividends. I'm just going to put in parentheses expense so we can think about it initially. Normally you can just record dividends because they're an assumed expense. And then we credit cash, decrease of an asset to pay for the dividends. Sorry, my alarm went off. And then we'll record a description of the business activity, paid dividends to stockholders. Okay, so we presented a lot of new accounts here, and this is your first time seeing some of the descriptors. We haven't talked about prepaid expense before. Accounts payable is new, accounts receivable is new, dividends are new. So a lot of new information here. This spreadsheet will be available to you, so you can review jointly with me as I've been walking through this, and give it a glance through and let me know if you have any questions. We'll keep rolling with the slides here. Now, this slide is summarizing all of the activity in the format they presented it. So they've been keeping track of the pluses and minuses of our assets, liabilities, and equity as we go through transactions A through H. And as we could see, the effect of every transaction is either an increase or a decrease in one of or more of the accounting equation elements. Remember, sometimes we were just impacting assets. Remember, like when we purchased the land with cash, that was impacting two different asset accounts. And the two sides of the accounting equation are always equal. So even if we're adding an asset, we're also subtracting the asset, so the net effect is zero. The stockholders' equity can be increased by amounts invested by stockholders. This is a new concept we introduced, and this is called common stock. And then the stockholders' equity account, or the equity account, can also be increased by revenues. Our example there was services earned, and we can decrease it with expenses. Our example in the last few transactions was we had wages, rent, utilities, miscellaneous expense, and then also supplies expense we recorded. And then stockholders' equity is decreased by dividends paid to stockholders. That was a new transaction as well. That was our last transaction. And we show that as an increase to an expense account in the form of dividends and a credit to cash as we use an asset to pay them out. Now we'll dive into the concept of stockholders' equity a little bit more. So stockholders' equity has two components to it, and stockholders' equity and equity is the same thing, just the same type of accounting equation we've been talking about, assets equals liabilities plus equity. That equity we've been referring to is the same thing as stockholders' equity. Stockholders' equity simply means we're referring to an organization that sells shares of stock to investors or stockholders. So stockholders' equity can either be common stock or retained earnings. We discussed common stock and showed it in our transaction H. So these are shares, in one of our transactions, then we paid dividends in transaction H. This is shares of ownership that we distribute to investors. And then there's also retained earnings. So this is the equity created through business transactions. So retained earnings is equivalent to net income. If you remember, that's our first financial statement we talked about. Revenue minus expense equals net income. And that's a component of retained earnings. So revenue and expense transactions are running through equity, and they're running through the retained earnings component, whereas investments in the organization or payouts of investors run through equity in the form of common stock. So again, stockholders' equity has these two components. We're either receiving equity through investments, or we're receiving equity through our operations or retained earnings in the form of revenue minus expense. And those two things are represented separately. This is actually a good infographic. I like it. So we have equity increases when stockholders purchase an investment in our organization, right? Remember, because we get cash and then they get share of equity. Anytime we distribute earnings to our stockholders in the form of dividends, that's a deduction from equity. anytime we earn revenue through fees, sales, whatever our main business operation is, that's an increase to equity in the form of a revenue. And anytime we have to pay out an expense to run our business, wages, supplies, whatever it may be, that's a deduction to equity. Revenue and expenses roll up into that concept of net income or net loss that we talked about. And then these three components are made up of retained earnings, whereas common stock is held separately over here. All right, so here we have a checkup corner. So these will be throughout all of the slides we'll go over this semester. And I like to take the time to do them, of course, but more importantly, I want you to take the time to do them. So this is extremely similar to what we just walked through in the Excel spreadsheet together here. So what the slides would like you to do is go through these transactions and decide what accounts are they impacting. Would it be an asset, a liability, or an equity increase or decrease? And then I'll add on the component of how would we record a journal entry associated with these activities. So I would encourage you to go ahead and stop the video and actually take the time to go through this yourself to make sure you're on the same page as me. And go ahead and start back up when you're done, and we'll walk through the solutions. All right, so I went ahead and I just put the checkup corner questions from the slides in this Excel so we can walk through them together. So there's some additional information the problem gives us too. It says that Drive Time Delivery, which is the business we're recording the transactions for, is a local delivery service operating in Cleveland, Ohio. At the beginning of the month, on February 1st, Drive Time has the following account balances. They have cash of $32,500, accounts receivable of $5,000, accounts payable of $2,500, common stock of $32,500, fees earned of $5,000, and wages expense of $2,500. So let's walk through the first transaction, item A. This is very similar, identical really, to the one we had recorded earlier. So we're receiving cash from the owner. So that's our debit, that's our asset, that's an increase to cash. And then we are recording common stock. They're investing in our business. I'm going to record it exactly for the amounts purchased. And that's that. We debited cash because it's an increase to an asset, and we credited common stock because it's an increase to an equity account. So if we're walking through the slides, this is an increase to an asset and also an increase to an equity account. And this is item A. Now if you move on to item B, paid creditors on account, $2,000. When we hear that expression on account, that means this guy right here, accounts payable. So we know that we're going to decrease a liability of accounts payable, and we're going to decrease an asset of cash because we have to pay the liability with something, and we paid $2,000. So what did we do here? We decreased a liability, and we also decreased an asset. Then we go on to item C. We received cash from customers on account, $5,000. This is a little confusing, but we're just flipping the situation in item B. So in item B, we owed money, right? We had creditors we needed to pay, people that had given us the option to pay in the future, and we need to pay them back. Now we're the creditor, right? We're receiving cash from customers on account of $5,000. Again, when you see that word on account, it means either accounts payable or accounts receivable. If you're receiving the money, you're going to record in this account accounts receivable because you had given someone the option to pay you in the future, and now they're doing that. Or if you're paying money, then you're going to record it in accounts payable because someone had given you the option to pay in the future, and you're now doing that. So an accounts receivable is an asset. So that will be one of our accounts, and then we're receiving cash, so that's also an asset. So I'm going to record that first because we're increasing cash in the form of an asset. And then what we're going to do here is we're going to credit accounts receivable. This is a new concept, so let's talk about it. Why did we do that? Accounts receivable is an asset. Remember, at the beginning of the month, we held an accounts receivable asset of $5,000. Actually, let's go through and do this. So at the beginning of the month, we had cash of $32,500. That's an asset. So we record it as a debit balance. We also had accounts receivable of $5,000. That's an asset, so we record it as a debit balance. We had accounts payable of $2,500. That's a liability, so we record it as a credit balance. We had common stock of $32,500. That's equity, so we record it as a credit balance. We earned revenues of $5,000. That was revenue is always shown as a credit balance. And then we have wages expense of $2,500. Expenses are always shown as a debit balance. So far our net income, our revenues minus our expenses, so far at the beginning of the month we had earned $2,500. We had cash and accounts receivable of $37,500. So these are our assets. Remember, our assets always need to equal our liabilities plus our equity. So our liabilities here are $2,500. Our common stock is $32,500, and then we have net income of $2,500. Incomes and revenues are always recorded as credit balance. So we have a liability, an equity, and then we have our net income so far. Notice that this number equals this number. So let's go back to our transaction of cash. So we received cash of $5,000, and then we credit accounts receivable because originally we were showing this as an asset, right? This was money we expected to receive from customers, and now they're paying us back. So now this balance will be zero, right? Because they're paying us back. So we need to show it as a credit. So what are we doing here? We're decreasing, or we're increasing an asset of cash because our customers are paying us back, and we're also decreasing an asset in the form of an accounts receivable. Let's go on to our next couple of transactions. We have item D. So here we're billing customers for delivery services on account for $18,000. This is very similar to our transaction up here. Let me find it. This guy. Only now we're not receiving cash, right? We used that fancy term on account. So this means that we get to record an account receivable. So we're billing our customers $18,000 because we delivered services. For delivery services, sorry. So I'm going to call it services earned in $18,000. Okay, why did I debit accounts receivable? Because it's an increase to an asset. Why did I credit services earned? Because it's an increase to an equity account in the form of revenue. Now I have item E. We paid wages expense of $10,000. I debit wages expense. That is a debit because a debit can be an increase to an expense account. And then I'm paying them in the form of cash because it doesn't say otherwise. I record it as 10,000. What's happening here? Well, I am decreasing equity, right? Because equity normally has a credit balance, so I debit it and I'm decreasing it in the form of an expense. Revenue increases equity, expenses decrease equity. And then I also decreased in asset because I needed to pay the cash for the wages. Now I have item F, pay utility expense. This is very similar. I'm debiting utilities expense because it is an increase to an expense account, so I debit, and I'm paying in cash. So we can record here what happened here. Well, this is a decrease to equity in the form of an expense. And again, it's also a decrease to an asset because we had to pay cash to pay our bills. And then lastly, we paid dividends of $4,500. So dividends are a type of expense. They decrease equity. And I pay them with cash. So here I'm, again, decreasing equity in the form of dividends expense, and then I'm also decreasing an asset of cash. And you can see this is how your slides present it. And you can walk through it this way if you want. We've essentially done the same thing. I'm just consolidating it in the form of journal entries as well, but we're still talking about the impact, right? We're saying, is this an increase or a decrease to an asset, a liability, or an equity account? All right, so after we've recorded all these transactions, remember in our first video we talked about this, we're recording all the transactions in the form of journal entries. Those are compiled in the general ledger, and then the general ledger summarizes by account and amount and creates something called the trial balance, and the trial balance is how we create our financial statements. So the primary financial statements are the income statement, the statement of stockholders' equity. It can also be called owner's equity if you're not a corporation or you don't have investors or sell shares of stock. There's the balance sheet, and then there's the statement of cash flows. We've already talked about all these in the first video, and I'm definitely going to take the time here to go ahead and go through them again, just so there's a lot of clarity, and so we're seeing the material over and over again because this is the entire basis for our course. So here's a good matrix. They have outlined the statements in the order in which they would be prepared. So first you have the income statement, and remember that's our revenues minus our expenses, creating a net income figure. We have our statement of stockholders' equity. So this is changes in our equity during the time period of our financial statements. So what we started with, plus any net income we earned, minus any dividends we paid, equals our new equity number. Then we have our balance sheet, and this will list our assets, and it will show them as equaling our liabilities plus our equity. And then we have our statement of cash flows, and this shows how we spent or received cash during the year. It will show cash via our operating activities, our investing activities, and our financing activities. Here's the income statement again. So here, remember we talked about the matching principle and the revenue recognition principle earlier in the slides. These come into play in the income statement, right? We want to show revenues when they're truly earned, and we want to show expenses when they're truly spent. So we want to make sure everything is properly reported in the same accounting period when it actually occurs. Another important thing to point out is just because the income statement is revenues minus expenses does not mean there can't be a net loss. You can definitely have more revenue than you do expense, so just keep in mind it can be net income or net loss. The statement of stockholders' equity is prepared second, and that's because we need that net income or that net loss number to calculate into our equity considerations. Then we have the balance sheet. So again, this is showing our accounting equation. Our assets are equaling our liabilities plus our equity. The balance sheet is as of a specific period in time. Remember, the income statement is showing our entire year of activity because it's showing all revenues and all expenses and what they sum to, whereas the trial balance is a point in time. If we're showing an asset of cash and we're saying the year end for our financial statement is 12/31, if we say we have $31,000 in cash, the next day we might not have that much anymore, or we might have more because transactions have occurred, time has passed. So the balance sheet is as of a specific date and point in time. Then we have the statement of cash flows. Again, this shows us how we spent or used cash during the year. It will show us if we had cash spent or used from operating activities. So this means things we do in the normal course of our business, the primary intent of our organization or corporation or business. If we normally are generating activity from sales, we're Target, then we'll see all of our sales activity here. If we normally generate sales from, if we're a hotel, we'll see how many people actually, spent revenue at our hotel in the normal course of our business in renting a room for the night. The investing section shows how we spent or used cash to acquire assets. So this is buildings, vehicles, things like that. And then the financing section shows how we spent or received cash from borrowing resources, like in the form of a loan or perhaps like a mortgage payable. If we earned any returns from our investments in the form of dividends or interest. And the important thing to note throughout the course is how all of these financial statements are interrelated and how an error in one of them can lead to errors in all of them. So we'll just go through some examples here they break out. So in the income statement, if your net income is recorded incorrectly, remember the net income goes into your statement of stockholders' equity, which goes into your balance sheet. So if you have an error in the first financial statement, your income statement, that's going to trickle through to all of them. All right, so we have a checkup corner here. So Lever Travel Services assets and liabilities are listed below, and they're as of the end of the year. And then the revenue and expenses for the year are also listed here. So accounts payable is a liability, accounts receivable is an asset, cash is an asset, common stock is equity, fees earned is revenue, which falls under the umbrella of equity, land is an asset, miscellaneous expense is an expense, falls under the umbrella of equity, office expense is an expense, it's an equity, supplies is an asset, and wages expense is an expense, so it's equity. All right, so here they're asking us to prepare an income statement, a statement of stockholders' equity, a balance sheet, and to show the interrelationship of these three financial statements. So again, go ahead and pause your video, and I want you to take the time to actually do this yourself. And I would say a good slide to use would be this one to remind yourself what goes into each statement. And this is your first time preparing them, so just do the best you can. The most important thing is identifying what type of account these are, whether they're assets, liabilities, or equities. And I just walked through them, so hopefully that's beneficial to you. So let's go ahead and pause and click back in when you're ready to go through this. All right, I hope everyone gave that an honest effort, used their book as a resource, and our first video from week 1. So we'll go ahead and walk through first the income statement. And one of the important things is to format everything properly. So every income statement should have the title of the company, which statement it is, and then this descriptor, like for the year ended December 31, Or if it's the trial balance is a point in time, so you would just say as of 12/31. So remember, our income statement is our revenues minus our expenses. So let's go ahead and identify any revenues here. These are assets and liabilities, fees earned. Looks like our only revenue are fees earned. So I'll go ahead and type that out, and I'm going to show them over here. And then which expenses do we have? I think we have a few. So we have miscellaneous expense, office expense, and wages expense. So I'm going to do wages expense first. Then I'll do office. Sorry, I didn't type that right. I'm not going to fix it. And then miscellaneous. So my expenses are summing to $207,650. So then remember, the point of my income statement is to show my net income. So I'm going to do that over here. I'm going to do equals my revenues minus my expenses. So my net income for the year is $55,550. All my income statement is my revenues minus my expenses. I create columns for them. I show revenues far to the right because they're a normal credit balance, and I show debits to the left because they're normal. Expenses to the left because they're a normal debit balance, and I come up with my number here. So this is the income statement. When we prepare that first, let's go to the statement of stockholders' equity. So I'm going to do the same thing here. Levart Travel Services, the name of the statement, statement of stockholders' equity, and I'm going to say for the year ended 12/31. So remember, our stockholders' equity starts with our beginning balance, and then we add any net income. We deduct any dividends, and we get an ending balance. And remember, stockholders' equity has two components, right? There's common stock, and then there's retained earnings. Retained earnings are any revenues, expenses, and dividends paid, whereas common stock is simply if you had an owner invest or you paid out an investor. So first thing we need to do is find our beginning balance, and our problem had some information about that. So it said the retained earnings were $30,000 on January 1st. During the year, no common stock was issued and dividends of $20,000 are paid. So I need to take this number, the $30,000, and put it down here in retained earnings, because this is what I started with. I take my net income number from up here, right, my $55,550. I put that in my retained earnings column because that's where it belongs. Retained earnings is made up of net income, which is revenue, expenses, and any dividend payments. And then remember, up here, our information, our problem also said, and dividends of $20,000 were paid. No common stock was issued. So that means our common stock column is not going to have any activity, right? Okay. So I know my common stock didn't have any activity during the year, but we do have a balance in it, right? Because up here we see common stock 100,000. So I'll go ahead and put that in here. And then I'm just going to make a totals column. So then our total retained earnings will be what we started with plus what we earned in the form of net income minus what we paid out in dividends. So our ending balance is $165,550. And these two columns are really important. We always want to show our statement of stockholders' equity or owner's equity like this, so we can differentiate between the types of activity. All right, then we'll go ahead and we'll create our balance sheet. That's our third statement we were asked to prepare. So Livart Travel Services balance sheet. And then we'll do as of 12/31. So remember, the balance sheet has our assets, and then they have our liabilities, and then we have our equity. So we come back up to the information, our problem, and we see assets. We have accounts receivable, cash, land, and supplies. So we go ahead and we break all those out. Accounts receivable, cash, land, supplies. Accounts receivable was this balance, cash, this balance, land, this balance, and then supplies, this balance. And then I'm going to make just a column called total assets. So I'll go ahead and sum these. So it looks like our total assets is 177,750. And then I want to look for my liabilities next. So I have accounts payable. Looks like that's it. Then I come down here and I say accounts payable. And that equals our balance here, 12,200. That's it. And then, so I'll just say total liabilities, and it will just be a 1. And then I have my equity next. And remember, equity comes in two forms: common stock and retained earnings. I get my common stock number from up here, right? Total common stock, 100. And total retained earnings. Let me summarize that column. All right. So I'll say total equity. Put at the bottom, sum that up. All right. Oh, that's not right. Retained earnings. Oh yeah, whoops, I need this plus this minus this. There we go. All right, and so then we do our final check, because what will we always remember? Our assets should equal our liabilities plus our equities. So we'll do total liabilities and equity, and we just do this value plus this value, and we have an issue somehow. Oh, I have a space here. And our assets equals our liabilities plus our equity, so we created a true balance sheet that balances, so that looks good. Let's go into our check. I think this all looks correct. You can go ahead and review this yourself, review what we went through. If you want to take another stab at it again, if you weren't able to get any of the statements or had any trouble identifying things, I think the most important thing you can do for yourself is this step we did right here, where we go through and we identify, is this a liability, an equity, or an asset? Because that helps us. And then don't forget the other information they provide. So we need to know our retained earnings at the beginning of the year, which they just tell us. We need to know if any common stock was issued or if any dividends were paid, so don't forget to pay attention to that little bit of information. Our balance sheet, income statement, and retained earnings should always have titles, so we know which statements we're preparing. All right, and then one of the last things we do in every chapter is we talk about some of the ways we can use the financial statement information to make decisions and analyze the performance of a company. So here we're looking at the ratio of liabilities to stockholders' equity, and this is helpful in seeing how companies are able to pay their creditors. So in the example we just did, we would take our total liabilities divided by our total equity, and that would be our ratio. Here they're using the example of Twitter and Alphabet, which is Google. So here they took 2 years of activity for Twitter and 2 years of activity for Google, and they said, what is the ratio of liabilities to stockholders' equity? So Alphabet, Google has a little bit of a better ratio, which might indicate they are better able to pay their creditors. The lower the ratio, the more likely the company is to withstand poor business conditions and pay creditors. Ideally, in all of the ratios, for the most part, we talk about this semester, you want to be under 1. So both of these companies have achieved that, but as you can see, Google is slightly better than Twitter. And remember, everything is relative. So these ratios are only as useful as the information we need to get from them and the type of companies we're comparing. Here, they're pretty similar companies in terms of structure and general business strategy. So I think this is a relevant comparison. One company might be bigger than the other, etc. So these ratios and the analysis that the slides present is only as useful as what we need to obtain from them. But this is an introduction of one of the first ratios we look at. If you wanted to go into financial statement analysis, this is something that you would do pretty regularly. And like I said, at the end of most of our chapters, we'll talk about the different ratios based on what we've learned in those videos. So, all right, I hope everyone understands the financial statements and some of the other components we talked about. Like I said, I like to revisit our learning objectives. So we talked about different types of businesses, right? We talked about sole proprietorships, LLCs, partnerships, and corporations. We talked about the role of accounting. Accounting has a lot of career opportunity. There's a lot of new regulations as a result of some poor ethical decisions by certain companies. We've talked about the underlying assumptions. When you look at a financial statement, you can assume the company will last in perpetuity, that the financial statements are verifiable, understandable. We know the accounting equation. We know assets equals liabilities plus equity. We've talked about this one quite extensively. We talked a lot about how business transactions can be recorded. We practiced all of our journal entries. We said, is this an increase or decrease to an asset, increase or decrease to a liability, increase or decrease to equity? And then we know the 4 financial statements. We know that errors in one of them can cause errors in others, and they're quite interrelated. And then we talked a little bit about the liability to stockholders' equity ratio and what that might mean for a company's ability to pay back their creditors. Please let me know if you have any questions as you work through your Cengage problems related to Chapter 1. I am available, as always, on email. Thanks for listening. Hope you have a good day.